going to be turned?
I think it's there's a chat and there's a Q&A, and I think that it's very possible that the one is off but one is on.
Trying the Q&A here.
Yeah.
Question. Yeah. Okay. Okay. That's great. Thanks.
There we go. Okay, Paul.
Okay. All right. Well, I'm Paul Morf. I'm a board member for the Iowa Natural Heritage Foundation, and we did another talk generally about estate planning, which is what I do. I'm an estate planning attorney and presently the chair of the Iowa Academy of Trust and Estate Council. And then Stacie asked if I would be willing to do maybe a few more once in a while. And so this is the second one, and this one is really about kind of the tax aspects of charitable giving and a few other things related to charitable giving. So for people who their estate plan or just their personal values involve philanthropy or giving to charities, this will provide some guidance, and maybe if you're doing it anyway, you might as well do it in as tax efficient a way as possible. So I'm going to start with a kind of a general top 10 list that I have. My 10 favorite ideas for people who are doing charitable planning, and these are ones I try to talk about with the folks that I'm doing planning with. But the first is, from a standpoint, it's always better to make gifts while you're alive than when you're dead. Because when you make a gift while you're alive, you get if you itemize at least, you can get an income tax deduction for your gift on the state and the federal. And certain kinds of gifts can qualify for a state credit. And then there are certain kinds of gifts that can give you a benefit even if you don't itemize, which we'll talk about. So whereas if you give money at your death, generally speaking, your heirs won't pay any tax on that, but you don't get a reduction in your income tax. So that's the main thrust there. It's also kind of nice to watch your gifts in action and get a chance to see your charitable legacy in place. So we'll talk about a couple things later that are related to this, but one of the things I do when I draft an estate plan, let's say I have a client that wants to leave $50,000 to Mercy Hospital when they die. I will include in their documents language that allows their trustee, if they have a revocable trust, or their financial power of attorney, if they have a will, to do an advance of that charitable gift. So if it's your plan and you have a dementia, but you still have taxable income, we could go ahead and make that $50,000 charitable gift while you're alive through your power of attorney or trustee in a way that would generate some income tax savings for you. And then that would count, if we earmarked it as an advance, it would satisfy the $50,000 that you were supposed to give to Mercy Hospital when you died. So I like to do that. And then the other thing we'll talk about later on is sometimes it makes more sense to make a lot of gifts in one year rather than a few gifts every year. And that is because the standard deduction is so big. For a married couple, it's $30,000, that if you just give a few $1,000s every year, or even $10,000 every year in charitable gifts, it may not be worth your trouble to itemize, and you may not actually get a big tax benefit from giving. But if you could make a big gift every 5th year, maybe to a donor advised fund, maybe just a big gift to the Iowa Natural Heritage Foundation and tell them they should keep it and count on it for the next 5 years, then in that year you wouldn't itemize and you'd get to deduct your contribution. So that's giving during life in a thoughtful way gets you more income tax benefits. My second on my top 10 list is, if you are making gifts while you're alive to charity, that $50,000 to Mercy Hospital in my example, it's always more tax efficient if you can fund that not with cash, but with some appreciated property. So that could be, maybe you have some shares of GE stock that you've inherited from your parents and you've just kept them, and they have a basis of $1,000, but they're worth $50,000. And if you sold it, you'd have to pay capital gains on all of that unrealized gain, that $49,000. If you gift those GE shares at a value of $50,000 to Mercy or whoever, and if you do it in kind, so you don't actually sell the shares, then you never recognize the capital gain. And when the charity sells the shares, they don't recognize gain either, because 501c3 charities don't have to pay income taxes. Not only do you get a deduction for your $50,000 gift if you itemize, you also avoid paying capital gains tax on the deferred gain. Now, if you hold those GE shares till you die, you get a new basis at death equal to the fair market value. So if you weren't going to sell them during your lifetime anyway, it's less important. But if it's an asset that you might have been going to sell during your life, or maybe you're afraid the stock market might go down and you'd rather not keep that position and bear that risk, and you're going to make a gift anyway, definitely best to make that gift with appreciated stock. It can also be appreciated land, it can be any asset that has a low basis and a higher fair market value. Number three, if you have reached the age of 70 and a half and you have an IRA, consider direct IRA. It's called a qualified charitable distribution, right? And so for people who are 73 or older, they actually changed the date for minimum required distributions to 73. You have to take so much out of your IRA or 403B or 401k every year. And when you take it out, assuming it's not a Roth, you will have to pay income tax on that. And so will any beneficiary you leave it to who's an individual. But charities, again, don't pay income tax. And there's a special rule that allows you to, after you're 70 and a half, direct up to $100,000 from your IRA only every year to a charity of your choice. And there are certain rules about that. It can't be to a donor advised fund or a private foundation, but it could be, for example, an endowed fund at a community foundation for the Iowa Natural Heritage Foundation, or it could be the Iowa Natural Heritage Foundation. And so if your required minimum distribution is $30,000 and you don't need the money and you don't want to pay tax on it, you could say, I direct that $30,000 doesn't come to me, it goes to the Iowa Natural Heritage Foundation. Or if you just as soon give more, you can say, even though my required minimum distribution is only $30,000, I directed 50 or 60,000, whatever amount you see fit, up to 100. Actually, it's 108,000 this year because of some inflation adjustments. So any amount up to $108,000 goes directly to that charity. And you don't get a tax deduction for that, but it never hits your income tax return. So it doesn't matter if you itemize or not, you still avoid tax on that income that would otherwise be taxable to you. Now, what if you don't have an IRA, but you have a 403B or a 401k? You can't do it directly from those, but you can always roll your 401k or 403B into an IRA without tax. And once you've done that, now you can do these qualified charitable distributions from your IRA. Similar is if you're a farmer, you can do the same thing with grain. If you direct that grain, a truck of grain is going to be delivered to market and that it is owned by the Iowa Natural Heritage Foundation, you are giving grain, which is inventory, to the Iowa Natural Heritage Foundation. You do not get to deduct that grain on your tax return, but you never recognize the income. And since the Iowa Natural Heritage Foundation is a charity, they don't pay income tax on it either. So sometimes farmers will do that. They'll say, I'm just going to give one semi-load of grain every year to Iowa Natural Heritage Foundation. I don't have to itemize, and I avoid tax on that income. So it's pretty neat. That's number three. Number four, I like endowed gifts through Iowa Community Foundations for the benefit of your favorite charity. So for me, Iowa Natural Heritage Foundation, because you get a income tax credit on your Iowa taxes. So the Iowa tax rate is only 3.8%. So if you deduct a gift on your Iowa return, you only get 3.8 cents back on your taxes. It's not that valuable. But if you can do it to an Endow Iowa fund, you get 25 cents back on your Iowa return for every dollar you gift. So it's much more powerful in terms of state savings. And I'll talk more about that later. Now, one problem with this is the current governor and legislature are looking to simplify the tax code. And, they've wanted to lower rates, but they're trying to still raise revenue to pay for things that Iowa needs. So some of these credits are under attack. And there's actually a bill pending right now that, if adopted, would get rid of the Endow Iowa tax credit, at least for future years, and possibly as soon as June or July. So if you were really thinking about doing this one, you might want to do it in April or May before any change in the law could happen. And then an Endow Iowa fund is a fund that is endowed, has to be at a community foundation, but for the benefit of your favorite charity here. So, for example, if you like INHF, you say, I want to create the Paul Morf Fund at the Cedar Rapids Community Foundation, and I actually have such a fund. And if I put $100,000 in that, I could deduct it on my federal return this year within certain limits, and I could get my 25% Iowa income tax credit, and there's a carry forward for that. And then every year, the Community Foundation will pay out about 4.5% to the Iowa Natural Heritage Foundation. So if it's $100,000 in the fund, $4,500 would pay out every year to INHF. And if they invest well and that value goes up, then it'd be more. And if the market goes down, it would be less, but it would always be whatever that spendable portion is, which is about 4.5% right now at most community foundations. So it's a permanent legacy. It kind of, you could say, I'm going to do that and it will replace my annual membership gift. And I'm going to get a larger deduction and a Iowa credit all this year when my income is still high. I'm still in a high, bracket, and I'll have a lot of years to absorb those tax benefits. So a lot of people do that. Also, if you do that all in 1 year, you're not going to itemize that year because you have a big charitable gift. And but in the other years, you maybe could take the standard deduction. So as we'll talk about, that's more tax efficient. Number 5, make lifetime gifts to public charities rather than private foundations to maximize your deductions. And an endowed fund or a community foundation can be very similar to a private foundation. So there are really 2 kinds of charities. There are more, but most charities are either a public charity, like a university or a hospital, or the Iowa Natural Heritage Foundation, or the United Way, where you have a board that's broad and has representation across the community, or you have a private foundation, which is really a family charity. Like the Ford Foundation or the Pew Charitable Trust. That's really set up by one family, and the family controls where the grants go. So Congress in 1968, I think, decided to treat private foundations differently. And so you cannot deduct gifts to the same extent when you make them to a private foundation during life. So you can deduct a smaller percent of your adjusted gross income, and also private foundations have certain excise tax limitations. So public charities are more tax efficient, especially for lifetime giving. At death, gifts are treated basically the same, but you don't get an income tax benefit either way. So if you said, I really want a charity where I can put money in it now, but decide where it goes later, instead of a private foundation, consider a fund at a community foundation, which is like a donor advised fund. And you put money in it now, but in future years, you give advice to that community foundation as to what grants come out of the charity. And they will generally respect your wishes. It's kind of like a mini private foundation inside a public charity. And you do get to deduct your gifts up to those higher percentages of adjusted gross income, which is usually 50% of your adjusted gross income if it's cash with a 5-year carry forward. Sometimes it's a little more than 50, some years it's 60%, but just assume 50% if you don't talk to your tax preparer. And if it's a gift of appreciated stock or some other asset other than cash, it's usually 30% of your adjusted gross income for a public charity. Whereas with a private foundation, it would only be 30% of your adjusted gross income for cash and 20% of your adjusted gross income for some other asset. So private foundations are not as good for funding during life. And then number 6, in Iowa, qualifying gifts of land and conservation easements generate a 50% Iowa income tax credit plus federal deduction. So those are very tax efficient. We talked about those a little bit in the last talk. I will come back to those later in this talk again. But a credit is better than a deduction, because if you have a 50% credit, that means doesn't matter what your tax rate is, you basically get half of the value of that gift up to the limit back on your state taxes. And there's a very long carry forward. So if you can't absorb it all in one year, you can absorb it over a number of years. Whereas a deduction, it's based on what's your marginal rate. So if your marginal rate in Iowa is only 3.8%, the maximum benefit you're going to get from that Iowa income tax deduction is 3.8% of your gift. So a credit is just much more powerful. Number 7, fund charitable gifts at death. So now I'm talking about planning for death instead of during life. So if at your death you're saying I want $100,000 to go to the Boy Scouts, fund that first with your tax deferred retirement assets. However, make sure the will or trust backstops this bequest. So I like to say, if you have an IRA or a 401k and it's not a Roth, if you leave it to anyone other than your charity, they will pay income tax. So you should always pick that asset first to give to the charity. And you can do that through a beneficiary designation. But always be concerned that your IRA could get spent, so it's not there, or it's at least not there to the amount you want to go to the Boy Scouts. So then I always backstop it in the will or revocable trust with a provision that says, it is my intent that at my death, the Boy Scouts get $100,000. I have attempted to fund this in whole or in part from beneficiary designations, but if my IRA and life insurance and so forth leave less than $100,000 to the Boy Scouts, make up the shortfall from my estate or from my revocable trust. And that allows you to ensure they get what you want them to get, but that it's funded in the most tax efficient manner. Number 8's a little bit complicated, but it is good in the right circumstance. If you have a business or a farm and you're going to sell it, you are going to pay capital gains tax if you sell it for more than your basis. But if you also have charitable intent, consider gifting that business or farm or a part of it to what's called a charitable remainder trust that benefits your favorite charity. A charitable remainder trust is a trust that pays up a certain distribution every year, usually a percent of the value of the trust, usually 5%, to one or more individuals, either for a term of years or for life. So for example, I could say, I'm going to put my farm, my 200-acre farm, in a charitable remainder trust, and I'm going to reserve the right to get 5% of the value of that trust back for as long as I'm alive. And after I die, I want my wife to get that 5% every year after she dies. So we can live off of that. And the farm's not producing 5% income, so we need that much to live on, so we'd like to sell the farm, but we don't want to pay the capital gains taxes. So we put it in this charitable remainder trust, and then we have the charitable remainder trust sell the farm, and it will not trigger gains when it's sold. Now, all of the distributions we take out will either be ordinary income or capital gains to us until that's all paid. But you can stretch that over your life rather than paying it all in one year and probably at higher rates. So the farm gets sold by the trust. There's no big capital gains event. The trust reinvests those proceeds in probably a portfolio of stocks and bonds. And every year we value it, and 5% comes out to me, or if I've died, 5% comes out to my spouse. And then when we have both died, the trust term says, pay it to my favorite charity, and here's what that charity is. And if I want to, I can even keep the right to change who the charity is. So if I change my mind, I can do that. But I also get a income tax charitable deduction for the percent of the trust that is the charitable interest. And that's an actuarial calculation based on my age and the age of my spouse when we set that trust up. So it's a nice way to avoid paying a big capital gains tax in one year, retain a flow of income, and make sure that the remainder goes at my death to my charities. If I don't want to retain the income for myself, I can do that and have the 5% distribution go to my children, for example, or somebody else that I care about. Some people have tried to do this with farm equipment. It's a little bit of a sticky wicket. So before you do it with farm equipment, which is not capital gains property, it's recapture, ordinary income depreciation property, talk to a specialist. There is another time that I like to use charitable remainder trusts that may not be on here right here, but so this is a little complicated, but the Secure Act changed the rules for what can happen after you die with your IRA or your 401k. Now, if your beneficiary is your spouse, it didn't really change anything. They can still take it out little by little over their life expectancy, and it's actually a very favorable actuarial table, so it's really more like their life expectancy plus 10 years. So they can defer it and it won't run out. And there are certain special rules for minors until they reach adulthood and for disabled adults. But for able adults, if I leave my IRA or my 401k to my children or adult grandchildren, they are going to have to take that out over 10 years, right? And so over that 10-year period, they will have to pay all the income tax. And we used to have the ability to defer that income tax over their life expectancy. And I can't do that except if I name a charitable remainder trust as the beneficiary of that IRA or 401k. Now, the charitable remainder trust will have to take it all out probably within 5 years. But again, charitable remainder trusts are treated as charities in a way, and they don't have to pay any of that income tax when they receive it. And they can pay 5% out to my child every year or grandchild. That 5% that's paid out will carry income out to my children. So, but it allows them to stretch it over their life expectancy. And then when they die, whatever's left goes to the charity of my choice and avoids income tax. So that's a way to still get a stretch, more income tax deferral on your non-Roth traditional IRAs and 401k assets. So that's a way to leave the fruit to my children or spouse and the tree to my favorite charity at death. And you can do that for another asset. I have clients who say, you know what, I've worked really hard. I've amassed quite a bit of wealth. I want to take care of my children, but I don't want them to get to decide what happens to what's left when they die. I want them to get the fruit from the farm, the income, but I want the tree, that bears the fruit to stay in the trust. And I want it to go to my favorite charity when my children have died, not to my children's favorite charity, because they may not have the same priorities that I do. So a charitable remainder trust at death works well for that as well. And then my 10th idea is a zero estate tax plan. And this was more important when the estate tax exemptions were lower. Today, they are close to $14 million per person. So a married couple today can leave $28 million free of estate and gift tax. That's most people. So this only matters for people who have more than that, unless those exemptions come back down. And they're actually scheduled to come back down to be cut in half at the end of this year. Most people think that this Republican Congress will pass a new tax law that extends those exemptions. But if they don't get their act together to get that done, your 14 million of exemption will be cut to 7. And so a married couple then would only have the ability to leave 14 million tax-free. And of course, every Congress can change things, so it's possible that it'll go down further in subsequent years. But a zero estate tax plan is just a plan that says, even if I want my kids to receive the largest amount that they can tax-free, I would like the excess that can't pass to them tax-free to go to a charity of my choice rather than taking a 40% haircut because the estate tax is a 40% tax. And so a lot of my clients will do that. Usually they'll leave something to the charity. Maybe they say, I want the Iowa Natural Heritage Foundation to get at least $100,000 when I die. And then I want my kids to get as much as I can leave them tax-free. But if there's more that would take a 40% tax instead of paying the tax, leave that as well to the Iowa Natural Heritage Foundation. So those are my 10 ideas. I have some more information here, and you'll get these slides about you naming a charity as a beneficiary or a charitable remainder trust as the beneficiary of your IRA, 401k, 403b. I've kind of talked through that one. And I like to have a bank trustee for these because it's kind of a tough job, and I'd like to have somebody professional managing the assets and making sure it's done correctly. You have to calibrate those so at least 10% of the value is represented by the charitable remainder interest, and the beneficiaries, the individual beneficiaries, have to receive at least 5% a year. And this, you can basically always make this calculation work if you use a unitrust, which is a trust where you recalculate the value of the trust every year. And so the 5% is multiplied by whatever that value is at the beginning of the year. So I think I've talked about that. The zero estate tax plan, I have some language here you could use on how you can make that work. So if you're talking to your own attorney, this is an idea of how you might implement that. If you didn't want to leave it outright to your charity, you could also leave it to what's called a charitable lead annuity trust, which is a more complicated structure that I guess if you had an interest, we'd talk about offline. But for truly wealthy families, sometimes they try to do it this way. For most ordinary people, not too important. And then I talked about the importance of if you're going to leave an amount to the Iowa Natural Heritage Foundation at your death, in this example, 100,000, we want your power of attorney or your trustee to be able to pay that while you're alive and disabled if you can afford it, so that we can get the income tax deduction. And so that we should do that, put documents in place that allow that to happen. And I have some language on how that could work as well. Okay. So I've got a number of ideas for how you'd structure these bequests. I'm not going to go through all of those. Maybe this is a good time for me to see if there's any questions on those general concepts before I go forward.
If you have any questions, feel free to unmute your microphone and you can just ask straight out.
All right. Well, I will proceed. If you think of one later, you can ask it. So the last time we had a significant change in the tax law was 2018 that affected charitable giving. And the reason it's maybe interesting to talk about is if this sunset happens, we're going back to that prior law. But there are a number of things that used to make it difficult to calculate your charitable gift. There was this thing called the piece limitation on itemized deductions. And so if you had a higher income, even though you theoretically got to itemize, you'd lose some of those deductions. And so it was always impossible to tell people and have them rely on what you told them in terms of what their tax benefits would be if they gave. There was also an alternative minimum tax that made it hard. And then there was the fact that because you could deduct your state income taxes on your federal return, and you also got a state charitable deduction, there was some slippage. So the math was really hard. The math is easier now because today nobody can deduct more than $10,000 of state and local income tax on their federal return. And the standard deduction has increased significantly. For single individuals, the standard deduction, which you get if you don't itemize, is $15,000. For a married couple filing jointly, it's $30,000. And so very few people are going to itemize anymore unless they have a mortgage or they give a lot to charity. Because if you're married and you have $30,000 standard deduction and you can only deduct $10,000 of state income tax, you have to have $20,000 of charitable gifts and mortgage interest on your home. And if you don't have that much, it just doesn't make any sense to itemize. So many, many more people are not itemizing, and it's harder for them to get a tax benefit for their charitable giving. There is also something that happened about the same time. where Congress has basically made the state income tax credits less valuable. And because Iowa has reduced its state income tax rate to 3.8% and is not charging that on retirement income at all, some of the state incentive for charitable giving is reduced. So there's a lot here, kind of analyzing the law, both before and after the change, and how does this piece limitation apply? And I'm not going to go through all of that, but I guess I just want you to know that we can now pretty much predict what the benefits are of your tax giving. This chart compares to 2017 before the legal change and today, just a little more easier to read. Your individual standard deduction has gone from about 6,000 to 15. Married has gone from about 12.7 to 30. So it got doubled, and then there's been an inflation adjustment. And it used to be you could deduct all your state and local income tax, now you can only deduct 10,000. You also can, there's more of a cap on what you can deduct in terms of your home mortgage deduction, which is the second major itemized deduction people have. And the third one, and really the only other one, is the charitable deduction. So in 2017, about a third of people itemized their deductions. Today, we estimate about 13 or 14% do. So much smaller number. Here's an example. A married couple, let's just say, has $300,000 of income, that's taxable income per year. They have a $250,000 mortgage that generates, well, I didn't change that. $12,000. They're paying $1,000 a month in my example, so it should be really 5% in interest. And they're giving $10,000 a year to charity. In 2017, they would be able to deduct $20,000 of Iowa tax, 10,000 charitable gifts, 12,000 in mortgage interest. They would have 42,000 of itemized deductions because their standard deduction was only 12.7 thousand. They got a lot more deductions if they itemized. They had 29,300 more deductions if they itemized. Their tax rate was 33%. So the benefits of itemizing for that taxpayer was $13,100. Today, they can't deduct the whole 20,000 of Iowa tax. It's capped at 10,000. So their itemized deductions have gone down 10,000 from 42,000 to 32,000. And their standard deduction has gone up from 12.7 to 30. So if they don't itemize, they get a $30,000 standard deduction. If they do itemize, they get a $32,000 of itemized deductions. The increased benefit of deducting is only $2,000 of deductions. Their marginal tax rate is less. So the benefits to itemizing for this family are only $480. And if it costs more to prepare their tax return and it takes more time to chase down all those receipts, they may just choose not to itemize at all. So it's a significant change. So if I still want to give to charity, what do I do so I can still get some tax benefits from doing it? That's really the question. And the main thing is, don't just give the same amount every year. Be a lumpy giver. Bundle your gifts and make them, I would say, if you can plan ahead, every 5 years is ideal. But even if you do it every 2 years, it may give you a better tax benefit. And you could do other things. You could try to pay 13 months of mortgage payments in the year you itemize. If you time things properly, or if you're under the 10,000 SALT cap, you could try to pay your property taxes 2 years in one calendar year or something, right? So, and if you really don't want your charities to get it all at once every 5 years, you can do this through a donor advised fund, for example, at a community foundation, where you make a big gift in 1 year, and then you direct grants be made from that donor advised fund to your favorite charities over the next 4 years, so that the charities see it as an annual gift, but you're able to deduct it all at once. So I've done a couple charts explaining how this would work, and I picked a family with a lot of income just to make it easy for the math to work. You'd have to run this yourself, but I have a married couple who's making $750,000 per year in taxable income. They have no mortgage debt, and they were giving $20,000 a year away in charity, and they would like to continue doing that. So on the left, if they just do this every year, their itemized deductions would be $10,000 of Iowa tax, that's the cap, plus 20,000 of charitable is 30,000. They get no tax benefit from giving to charity because their standard deduction is 30,000. They get no increased deduction if they itemize. So the tax benefits of itemizing is zero. So it's great that they're giving to charity, but they're not getting any kind of a federal or state match. What if they just say, you know what, we're going to do this every other year. Every other year, we're going to give 40,000 to a community foundation, donor advised fund, and then we'll have them, distribute it over 2 years to my charities. Now, in the year they make the gift, they get still the 10,000 Iowa tax deduction, the SALT cap, plus $40,000 charitable gift is 50,000. Well, that's quite a bit more than the standard deduction, so they will itemize. The benefits of itemizing will be the extra 20,000 they get to deduct at their 35% marginal rate. That will save them $7,000, and on an annualized basis, that saves them $3,500. My next slide is, what if instead of doing it every 2 years, they do it every 5 years? So 20,000 times 5 is 100,000. They could do that. Give that all at once to a community foundation donor advised fund. In the year they do that, now they have $110,000 itemized deduction, standard deduction of 30. So the benefits of itemizing that year is 80,000. And if that's all at the 35% rate, they would get $28,000 tax savings on their federal return alone in the year they itemize. And if you spread that over 5 years, that's about $5,600 a year of tax savings. So it does save them significant taxes. I have a little chart here, depending on how often you make your gift. If it's every 2 years, it's about $3,500 a year you save, and it increases marginally, the more years you can do it. So that is definitely a way to still try to harvest more tax benefits from giving. Ideally, you could fund those with appreciated stock, right, and avoid capital gains. There is a 5-year carry forward. So if you can't absorb the whole $100,000 in 1 year, you can carry it forward, but now it's not being lumpy, right? Now you're not being able to absorb it all in 1 year. So you're not going to be able to take the standard deduction in those other years that you have to absorb some of it. And then I actually did this in 2017 when I knew this law was going to pass. And I thought it would take me 4 years to make grants out of my donor advised fund. But once it was in there, I kept finding things I wanted to do, and it only lasts me 2 years. So that's the only other concern, is you might end up giving more to charity than you anticipated once you have this charitable fund. So that's that. I wanted to spend a little time on the Iowa credits and how they've been changed by the IRS rules that were adopted right after this 2018 tax law was passed. So there are 3 I'm going to talk about. They have all changed over the last few years. The first is qualified school tuition organizations. These are organizations that help people who are not wealthy, not your own children, other people's children, go to parochial school or other private schools. And if you give to one of these, you can get a 75% credit. So 75% of that you can get back on your Iowa taxes. The Iowa legislature has increased this actually from 65%. They really want people to help private schools. Obviously, they're doing things with vouchers as well. There's a cap every year, up to 20 million of these credits are available. Then there's the one that I like, which is conservation gifts of land. So I give my farm to Iowa Natural Heritage Foundation for conservation. I give a remainder interest in my farm to Iowa Natural Heritage Foundation for conservation, or I give a conservation easement in my land to Iowa Natural Heritage Foundation. If I do that, I get a 50% Iowa credit, capped at $100,000 credit per person. So for a husband and wife, could be 200,000 probably. And that's 50% of the gift. So if it's a $200,000 value gift, I could get a $100,000 credit. If my wife gave half of that, she could do the same thing. If we give more than that, the excess would be an Iowa deduction. And so sometimes we would say, well, don't do it all in 1 year, spread it out so you can get that credit every year. If you can't absorb all of that in 1 year, which most people can't because you don't pay that much Iowa tax, you can absorb that gift over 21 years, 20-year carry forward. That's really powerful. It's a great way for Iowa to incent people to leave land or conservation easements to the Iowa Natural Heritage Foundation. And then the third we talked about already, if you do this at an endowed fund at a community foundation, and it's for Iowa purposes, you get a 25% Iowa credit. Those are capped at $6 million a year. A single donor can only get a $100,000 credit a year now, which would be a $400,000 maximum gift in 1 year you could get the credit for. There used to be a wait list. There's no wait list anymore. If the credits are gone, which happened in early December of last year, you would just apply and get a credit for the following year. Right now, there's 4.3 million of that 6 million. They're going to go fast because there's some concern that as early as June, the Endow Iowa credit could be abolished. So if you're thinking about doing this, I would do it very, very soon. I hope it's not abolished, but it's on the chopping block. So the government has decided that these credits are too good of a deal when paired with the current tax law. And they may sometimes be right, but the way they've decided to go about this didn't really make sense to me. So you can deduct on your federal return what you give to a charity, including a government, but not if it's quid pro quo. So for example, I give money to the, let's say I give money to, I'm trying to think, the United Way, but they give me back a tote bag that has a value of $20, right, to thank me for that gift. I will get a letter from the United Way saying, well, we got a gift of $100 from you, but you received valuable goods of $20 value, so your net gift is only $80. Because part of it's a quid pro quo, right? It's almost like a bargain sale. I'm buying a $20 bag for $100. I only get to deduct the extra 80. Well, that makes sense to me. But what they are doing is saying these Iowa tax credits are a quid pro quo, where the government is basically buying things from you with these credits. And there's a safe harbor for credits that are no more than 15%, but all of Iowa's credits are more than 15%. Now that makes sense to me to a point. If you're giving the land to the DNR and the DNR is giving you a credit, through the state of Iowa, that could be seen as a quid pro quo. But the Iowa Natural Heritage Foundation is not the state of Iowa. It's not a government. It's a private charity. It doesn't get to give you the credit. It's a third party that's giving you the credit. So I don't really understand legally how this is justified, but I do understand that some of these credits get to be pretty significant. In fact, that state tuition credit of 75%, if you got that plus a federal deduction, you'd actually be making money because your federal deduction at 37% plus your 75% credit would give you back about 112% of what you gifted. So there is some math that makes this have some sense behind it. But an example here, if I give $10,000 to the community foundation and I get a $2,500 Endow Iowa credit back, the new regulation says I can only deduct on my federal return the other $7,500 because that Endow Iowa credit is treated as a quid pro quo. And so I get a $2,500 state benefit, but then I only get to deduct $7,500, not the full $10,000 at the federal level. Let's talk about the Endow Iowa tax credit for a minute and how that is impacted. You get a 25% credit for an endowment gift to a qualified Iowa community foundation. It has to be for a cause in Iowa. It's been very good to incent people to create these endowments for Iowa causes. You can read more about it at iowacommunityfoundation.org. You do get a 5-year carry forward. By the way, you don't have to itemize to get the benefit of this. Even if you don't itemize, it still reduces your Iowa income tax. Even though if you give grain, that never shows up on your income tax, you still get a credit if you give grain. Same thing for an IRA if you do that qualified charitable distribution from your IRA to your charity, and your charity is a endowed fund at a community foundation, you can get this Endow Iowa credit, even though you never have to report that IRA money as income. And you can also do this with appreciated stock. So they're very powerful. You can have a donor advised endowed fund. You can do one that is created by INHF or some other agency for the benefit of that charity, or you can designate a named fund, the Paul Morf Endowed Fund for the Iowa Natural Heritage Foundation, permissible. And you can also just give it to the community foundation unrestricted. You can only spend up to 5% a year, so it's endowed, but we let the community foundation decide what will most benefit the community. So if you direct your charitable IRA, you have an IRA and you don't want to pay income taxes, so you direct that up to $108,000 a year goes into an endowed fund for the Iowa Natural Heritage Foundation. You avoid income tax on that money, whether you itemize or not. You get a 25% credit until it gets repealed. If it gets repealed, you won't be able to do that anymore. So it's a really neat opportunity for people who aren't itemizing to get significant Iowa income tax savings through these distributions from their IRAs. The rules for the charitable IRA rollover, you have to be at least 70 and a half. It caps out at 108,000 this year. It will go up with inflation in future years. It has to go directly to a qualified charity, not from you to you and then from you to a charity. And it has to be an IRA, not a 401k or 403b or simple or SEP plan. And it cannot be made to a donor advised fund for this to work, but it can be made to an endowed fund for an agency like the Iowa Natural Heritage Foundation. So I think charities should partner with community foundations to create these funds and then encourage people to do their IRAs directly to them and take advantage of these benefits. Let's see. I have a couple examples here. I think this one we've kind of talked through. The second one, I'm going to use this here and then I'm going to compare it to just giving it directly to Iowa Natural Heritage Foundation. And the punchline is that it's more tax efficient to just give it directly to the Iowa Natural Heritage Foundation. But I wanted to show how this would work. If John Brown has an adjusted gross income of $500,000 and he donates his 40-acre farm to the community foundation in an endowed fund benefiting Iowa Natural Heritage Foundation. And if the basis of that farm is $1,000 an acre, but the fair market value is $10,000 an acre, John has made a $400,000 gift. It will take him 3 years to absorb that gift because he can only deduct appreciated property up to 30% of his adjusted gross income. So he can only absorb $150,000 a year, but he has a carry forward. So over 3 years, he can deduct all of that gift. He will get a $100,000 state income tax benefit, which is the max because of the Endow Iowa credit, right? And he will only have 5 years to carry that forward instead of 20, which he'd have if he gave it to Iowa Natural Heritage Foundation for conservation. If he has a 35% federal marginal rate, this gift will create a federal deduction not of $400,000, but of $300,000. Because the credit is treated as a quid pro quo, he only gets to deduct the portion of his gift that is not get an Iowa credit. So he gets to deduct $300,000. Since his rate is 35%, that is another $105,000 of tax savings. So he gets a total tax savings of $205,000 in credits and deductions. And since he's avoided $360,000 of taxable capital gain, if his plan was otherwise to sell the farm, he's really avoided another $72,000 of tax. So you could say that his total tax savings is $287,000 or 72% of the value of the gift, which is pretty powerful. But if he gives that farm to INHF for conservation, it's actually even better, which we'll talk about. Okay. So Iowa and the federal government have tax incentives if you give a qualified real property interest, like a farm, or a remainder interest in a farm, or a conservation easement, to a qualified organization like the Iowa Natural Heritage Foundation, exclusively for conservation purposes, right? A conservation purpose means preserving lands for outdoor recreation of the general public, or protecting natural habitats of fish, wildlife, plants, or ecosystems, or preserving open space, including farmland and forest land, for the scenic enjoyment of the general public, or pursuant to a clearly delineated federal, state, or local governmental conservation policy, and if it yields a significant public benefit, or certain historically important land areas or structures, like, the governor's mansion or something. The federal government, and Senator Grassley was part of this, by the way, you can deduct up to half of your adjusted gross income every year. And if you're a qualified farmer or rancher, and this land will be open for grazing or crops, 100% of your adjusted gross income. And you get a 15-year carry forward. There are some new rules to prevent abuse. If you have property that you have not owned for at least 3 years, and it's in some sort of an LLC, and you're trying to deduct more than 2.5 times what you paid for it, beware, but I doubt any of you are doing that. In addition to the federal deduction, Iowa since 2008 has had this 50% credit for the value of the property. And your maximum tax credit per donor is $100,000, so up to half of a $200,000 gift. And Iowa has a 20-year carry forward, so really powerful. If you gave more than that, you can get a tax deduction for the rest on your Iowa return. How does this work? So here's a first example. A qualified appraisal shows that the farm is worth $300,000 for development. The donor decides to put a conservation easement on it, giving up the right to develop, subdivide, or make changes to the property that would reduce the conservation values of the property. A qualified appraisal says that after we put that conservation easement on it, it's only worth $100,000 as open space for wildlife, habitat, public recreation. So it reduced the value of the property from $300,000 to $100,000, which is a $200,000 gift. Donor's adjusted gross income is $800,000, so he is in the 37% rate. And he files a timely return fully documenting the gift, attaches a qualified appraisal, which meets all the requirements. He gets a $100,000 credit, which is half of his gift, on his state return, and he can deduct that. He can absorb that over the next 21 years. In addition, even though it's a $200,000 gift, now, before 2018, he would have been able to deduct the $200,000. Now, after 2018, he can only deduct the other half he doesn't get a credit for. So at a 37% rate, he gets a $37,000 federal benefit, $100,000 state benefit. Both can be carried forward for a very long time. His total tax savings are $137,000, and he still owns the land, right? He still is doing what he wants to do on it, which is hunt for mushrooms and watch birds and fish and hunt. So that's pretty cool. That is about 68.5% of the value of the gift he's made. So a conservation easement will allow you to retain and exclusively enjoy your land, ensure the protection of the conservation values of your land in perpetuity, harvest significant tax benefits by giving up rights that you didn't want to exercise anyway, and that you don't want your kids to exercise after you die. Does not involve the government or public ownership, and everybody with a piece of land you love should at least be considering doing this. My second example is John Brown. So if we have the same person that previously gave his $400,000 40-acre farm to a community foundation to put in an endowed fund for Iowa Natural Heritage Foundation, what if instead he says, I want to give it to Iowa Natural Heritage Foundation for them to own, and I want them to own it permanently and protect the conservation values, whatever those are, right? Well, now he's made a $400,000 gift to INHF, but instead of 3 years to absorb, he can absorb it in 2 years because he can deduct up to 50% of his AGI rather than only 30. And if he's a qualified farmer or rancher and INHF will graze or farm it, he could absorb it in 1 year. he will get $200,000 state income tax benefit over time, if he has the ability to absorb that, which is half the gift. That's a 50% credit. It's actually capped at 100,000, but if he's married and he and his wife each do half, they can each get the $100,000 credit for the gift. And then if they get $200,000 in credits, he can deduct the other half of the gift at a 35% rate. That would be a $70,000 federal benefit. So he can get $270,000 in federal benefits. And then if we add in the capital gains taxes he's avoiding, it's $342,000 of tax savings, which is 85.5% of the value of the farm. He essentially can get back if he was going to otherwise sell the farm. So if you're saying, shall I sell the farm or donate it to Iowa Natural Heritage Foundation, and you can live long enough to absorb all these credits and deductions, you're just about as well off to just give it to INHF as sell it. It's pretty powerful. So a gift of low basis land to INHF for conservation is about the most tax efficient charitable gifting strategy that is available to Iowans. Last slide here. We talked about this, but the difference between a private foundation and a donor advised fund. A private foundation is a standalone organization that you control, your family controls. You can decide how it's invested, who invests it, and you can give to anybody you want as long as it's within the law, and there's nobody else whose permission you have to get. On the other hand, if you earn money investing, there's a 2% excise tax on that earned income, and you're going to have to prepare an annual return that you file, so there are some costs. And if your kids are not conservationists and decide to give to something you don't care about, you have that risk of mission drift. A donor advised fund is a contractual agreement between you and either a community foundation or some other financial institution, like Hills Bank has one. You can do one at Hills Bank. So it's a public charity, so you can deduct more if you give during life. There's no excess tax. There's no startup costs, and they will often charge you about a 1.5% annual fee, but you don't have to do a tax return. And then there's a community board and your gift agreement will protect against mission drift. So there are pros and cons to both. If you're talking about something less than $2 million, it almost always makes sense to do a donor advised fund. For people who want to do $10 million or more, I often think a private foundation makes sense. That's it. And there's some more stuff in here that if you run a nonprofit, you should know about how Iowa regulates nonprofits, but I'm going to stop there because it's 12:57. I'm going to ask again if there are any questions. Stacie?
Yeah, I posted one on there.
Okay, I'll look. Can you gift farmland if there's still some mortgage on the property? That's a good question. So the conservation easement is a little complicated, but yes, you can. You should talk to your accountant because I think the math's a little different. And then you need to talk to the charity, right? So if you had a farm that was worth $1 million and it had $200,000 of debt on it, the question would be, would Iowa Natural Heritage Foundation accept that gift? And I would think they would, as long as they either had the right to sell the property or they had some way to fund the debt, right? So, but it's a little bit more complicated asset for the charity to accept. And the debt, because it's debt, it's going to reduce the value of your gift by the amount of the debt. If your debt was more than your basis, so if you had a basis of 100,000 in the farm and debt of 200,000, I think that could be a deemed sale. There are some challenges there, but as a general matter, it is possible to gift land with debt. Usually, when we're talking about conservation easements, we advise people to get the mortgage paid off before, and I cannot right now remember why, but I think there's a reason. Yeah.
Okay. Yeah. No, that's fine. Yeah.
Okay. Well, that's a lot for an hour. Hope there was something in it for you. Feel free to email me if you have a question. If there's another topic you think would be of interest that we haven't covered related to estate planning, let Stacie know, and we've talked about doing another one maybe late this summer.
Well, thank you very much. It was just wonderful. It was very, very thorough. And I'm a little overwhelmed, but we'll do our best.
I'm sorry.
So you got to be thorough. You got to be. I appreciate it.
Okay.
I'll be sending out this recording as well as Paul's slides, and I will be asking you if you have any other topics that you would like to see discussed in this way, that INHF and Paul could work together to address. That would be great.
All right.
Okay.
Thanks,
you.
everybody. Yeah.
Thank you all. Appreciate
Bye-bye.
it.